Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, September 5, 2024. We are looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on that docket today? Well, they finally got to the elusive 548.88. They spiked it, they rallied back, bounced back just to close back above it. We mapped that out early in the day today in the live trading room, and inside the numbers, they pretty much did exactly as we mapped it out. Maybe not necessarily the easiest thing under the sun to trade, but if you have a beat on what they're doing, and you can identify the reason they're doing something and what they're likely to do after they do the thing we just talked about, you've got the makings of a trade setup. The harder thing to do was trade down to the 548.88. That's what I explained to traders in the live room this morning. It was much easier to trade a spike of 548.88 back above than it was to trade down to get to run a test of that important place. Well, now let's talk about what happens now that they have run a test of that important place. Do they stay above, find a low, and begin to rally back up, at least rally back up the breakdown candle that was created on Tuesday? That is option number one. Option number two is they get back inside 548.88 and they start leaking down to go fill the gap below and or lower. The or lower stuff is, of course, the trend line that we have, the long-term trend line, and other stuff. For now, the gap, which happens to be at 543.75, would be the next target underneath 548.88. What's the reality of how these things work? What are we looking for? What are the expectations from a how does this thing really happen perspective? Well, they typically don't hand you the easy thing right out of the chute. For example, are they going to run right down and fill the gap tomorrow if they're below 548.88? Well, they didn't do it today. They spiked below it, and you could see from an intraday chart perspective, they spiked below it. They come back above it. That was the trade. That was the trade we talked about. What I told traders in the live room today, and you'll see this written in the notes as well, is getting below, let them spike it. They will fight back to at least 548.88 at some point, if not higher. And the next thing higher was at least 550, semi-fat round number, and so on. You'll see it all in the notes. But what we're talking about is what happens if there's more leakage, if you will. Are they going to make it easy and trade them right down to fill the gap and or lower, or do they go halfway home, spike them back up, find some kind of a low, rally for 2, 3, 4 days, and then hit them again in a week or so? That's more like how this thing normally unfolds. It's very unlikely the trick, trap, fool, and frustrate crew are going to hand you the easy trade each and every time. Once in a while, sure. Do they hand you the easy trade the large majority of time? Meaning, hey, let's just take a short, even though the market's down a lot already, let's take a short and we'll cover it at the gap. No problem. Yeah, no problem. They don't let you have that one so easy. They like to screw two factions, I should say, of traders. The one waiting for the gap to exit, they come up short, bounce them back up. The one looking to buy the gap, they leave them standing at the altar. They never get there. They bounce back up. Next time down, they trade right through it. Screwing two factions of traders. What happens if they just flat out stay above 548.88? That's okay. That is the bull case for a bounce back up above the 20-period moving average and to begin to climb the breakdown candle from Tuesday. And if they get anywhere near the top, they'll be pushing on 560, 559, 561. They'll have already rallied 120 S&P handles, give or take. And we'll start to discuss, hey, they're once again a stone's throw away from the most recent high. We'll take it one day at a time. We will be the umpire calling balls and strikes. All in all, at the end of the day today, it was relatively narrow ranging day, not a big ranging day for the S&P. However, they did the thing where they get into no man's land, pop them back up, give you the scalp with potential. That was the objective. Now we'll see what they're made of. Do they stay above or do they get back below? How do they handle the opening tomorrow? Are they gapping down below? Are they gapping up away from this place? We'll see what happens on Friday. Speaking of inside the numbers, we'll take a look at the commentary. We'll check out some stocks on the move. We'll talk a little bit about what happened in the live room. Where were the trades today? Did anybody make money today in the live room? Did you buy the spike of 548 and just wait around? When they popped them back up, you took your money and you said, thank you very much. Because that's pretty much what the schematic was all day long. Quiet overnight session. We have a pivot today at 551.35. If they're above the pivot, this is obviously the bull case. Where do they go? 553.20. Here's a little taste test on a 5-minute chart. Right of the vertical is today's activity. The middle line is the pivot. We'll make that one green. Above, she's bullish. Below, the door is open for 548.88. That's what I was pounding the table on all morning long. Above, she's bullish for what? 553.20. What's 553.20? Overhead resistance. The most important number on the downside is a gateway to a whole new leg down to 548.88. Let's see what we have as the morning starts to unfold. We had some phony jobs number come out from ADT. We've got the 8:30 economic data release. So we're looking at the pivot. We're looking at the other day's lows, yesterday's lows, and we're looking at the gateway, 548.88. Remember, pause the video, read the notes, go back to the chart to double check the work. Phony jobs data amounted to a whole lot of nothing. 551.35 is the pivot. Above on candle closes, begins to open the door for 553.20. What happened? They went up to 553.20. Did we have some traders that took that ride? Sure we did. Again, let's see what else we have as the day gets underway. Right out of the chute, 551.35 is the pivot. Above, she's bullish. Below, she's not. Pause them, read them, go back to the chart to double check the work. 553.20 is a target while above the pivot. Very simple to understand. It's in black and white. What happens if they get above 553.20, which they didn't? There's a next number in the sequence. You didn't need that, but it's all in here. Everything traders need each and every day is in here to be successful with the markets, with the S&P, whether you're trading ETFs, micros, exchange-traded products, S&P, ES futures, options on futures, options on SPY. It doesn't make any difference. They're all directional trades. Still looking for 548.88 and now a spike of it. By 11:03, 548.88 on the table. First time, best time. It's a bounce back situation for a scalp with potential. See what we're saying here? It's all in here. Read the notes, go back to the chart, and double check the work. It's not tremendous, but they spike below 548.88, the blue line, the lower blue line. And what happens? Eventually, they get back above, and they get back to first 548.88, and then they get back above. And it's the thing where sometimes it just takes time, and time is more important than price. You could see here, above, on candle closes, we're talking about 548.88, and I called 548.88 now the pivot for the rest of the day around lunchtime. Above on candle closes is the bull case for a snapback rally type situation. Back to 550 for starters or higher for starters. So what happened? They almost got back to the original pivot, 551.35. They got well above 550. 550 was for starters. Did they go up enough to make a trade out of it? Absolutely. If you bought a spike of 548.88, they gave you whatever you wanted. 20 handles, 25 S&P handles. They gave you the deal. What about stocks on the move? We had three possibilities today. We had AZN, CPRT, and CRDO. Who ever heard of those guys? But let's take a look at the charts. The number in AZN was $83 even. The next number down was $82.20. They didn't get there. So they floundered around $83 even. They gave you a little bit of a pop above, not much. maybe about 35 cents, give or take, hung around and closed pretty much right around 83 even. No harm, no foul, just a dud for Astra. Next one on the board was CPRT, 48.90. 48.21 was a zone. They never got to the second number. They popped them back above the first. They gave you the deal. We had traders all over this thing in the live room. Nice profits there. Came back for a retest. Another bite at the apple if you wanted it. Nice little quick scalp trade. They did it nice and quick, painless. There's one for you, CRDO. Look at what happened early in the day. Came into 26.15, first number. Ricochet right off of it. Minutes later, you're at a high of 28.21. Plenty of traders in the live room took that rocket ride. Now, if a trader wanted it later on, you could see what they did. They bounced around off the numbers later. This is an indication of what? That the numbers work, but the trade was here first thing in the morning. After you pocket something like that, you're not looking to take another bite at this apple. What's going on over in Camp IWM? Well, Camp IWM is a little bit different than the spiders. You see, they're teetering right around and below the convergence of these moving averages. That was the same for the last day or so. However, they have this no man's land, entrance to no man's land, gateway situation down at 210, and they're not there. And we'll see. There was some relative weakness today in the IWM, and namely the transports, which we'll look at later. Not a tremendous amount in the IWM, but more so in the transports. We'll see if there's more to come. Below the 50-period moving average is certainly a warning signal. It's a flare-up in the air, a shot across the bow, if you will. You look at a 4-hour chart, for example, and you see the convergence of moving averages. You see the last red candle here to get below them, and you're staying below in the final candle of today, below the convergence of the 50 and 100 period moving average. So just drilling things down a little bit, narrowing things down, trying to look for either an anomaly or confirmation or some other information that's helpful in the spirit of being the umpire calling balls and strikes. We got to go to other time frames. So here's a picture of the 4-hour chart. What do you see on a 2-hour chart? Well, similar situation. You have a market that's eating time off the clock under a convergence of a 200 period and a 100 period moving average, making a bearish wedgish pattern after a move down. So you got a bearish wedgish flaggish thing underneath the convergence of moving averages on a 2-hour chart. How many traders are looking at a 2-hour chart to even see that this is happening? I don't know the answer to that, but I'm looking. What do you have on a 1-hour chart? Well, you have another bearish flaggish thing below all the moving averages. So you have to look at this and take it at face value and say, hey, the stuff on the IWM is bearish. This is my favorite market leading indicator. I don't see the thing carving out a bottom. I don't see the thing putting in a bottom that we want to chase up in other markets. I don't see this thing leading to the upside, not just yet. This is the awareness. This is the umpire calling balls and strikes, looking around the horn at all the other markets and seeing what you see, being impartial. Staying on the 1-hour chart and going over to the IYT, which is the exchange-traded product that tracks the transportation stuff. You know, the folks down at the transportation depot department, bearish pattern. Do you see the same thing in the regular transports? Similar, not exactly the same, bearish pattern. Below all the moving averages, making a bearish pattern on the hourly chart. Let's work our way up. 2-hour chart, same routine. 4-hour chart, similar routine. You've got a convergence of moving averages and they're stuck. They can give it up. They can have a rescue. We'll see. No longer are they teetering at the top end of the triangular pattern, if you will. Back to the daily chart, and you can see they gave up the ghost today, down a whopping $300 in the transports. Again, another false or attempted breakout and a big down day, all the way into all these moving averages, right to the 200, and a bounce off the 200 period moving average on the daily chart. Again, my favorite market leading indicator is the small caps in the IWM. Second favorite are the folks down at the transportation department, but they are and remain a number one canary in the coal mine. Certainly not a positive, bullish indicating type of day for team transports. Flip side situation, you got the Q people up 43 cents. We'll call it flat-ish, up about 0.1%, but they were up nonetheless. But look what they're doing. Daily chart eating some time off the clock underneath the 100 period moving average after a pretty good down day on Tuesday. So here we are. This is a bearish setup now, eating time off the clock over a no man's land situation where on the other side of that is a gap. So you see what's going on here. You pick apart each individual chart. All charts act and react the same way, but each chart is independent of one another. You might look at the Qs and say, hey, they were up a little bit today. That's a positive sign for the overall market. Then you look at a daily chart and you say, yeah, but they're eating time off the clock below the 100 period moving average. And if they keep doing that, they're setting up, building energy to do what? Go lower. Time is more important than price. Maybe, just maybe, they're not ready yet. About the XLF. Earlier in the week, we talked about one of the traders in the room, Kenny W., had a beat on XLF into an on-time type of situation, made a new high, did not close at a new high, and here they are, lower. Now, sure, they can come back just to run a test of home base, the 20-period moving average, but part and parcel to that whole thing is what were we saying? They were a little bit extended, a little bit far from where? Home base. What's home base? The 20-period moving average. See how this works? All charts act and react the same way. Doesn't matter, we're talking about the S&P, the XLF, IBM, Apple, Google, Nvidia. It doesn't make any difference. All charts act and react the same way. So here, let's project out a little bit in the XLF. What happens when they get down, if they get down, when they get down to the 20-period moving average? Well, guess what? We're going to expect a bounce. Why? Not just because of the 20-period moving average. There's other stuff. Don't you have a most recent breakout area where the market ran up to this place, couldn't get through? Ran up to that place again, couldn't get through, was rejected. Next time up, they bust through, come back to retest the most recent breakout area, which in this case now happens to coincide, at least right now, with the 20-period moving average. So you got a couple or three reasons why you might get a bounce if they get down there anytime soon in kind of one fell swoop over the next day, 2 or 3 type of situation. XLF bounce area around 44. Might want to write that down, put it on a sticky note. What's going on over at Smashmouth Country? Nothing. They're eating some time off the clock, similar to the Q people. We're not going to belabor the point. The chart doesn't look good. It looks like they put in a lower high. They can put in a higher low off this low, a higher low here, try and rally back up. But right now, by definition, you have a lower high situation. So the door would be open below the 200-period moving average to retest the lows and or go lower. If that's happening, everything else under the sun is likely selling off simultaneous. If I told you how much I appreciate each and every one of you, without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.